Will all the companies that have raised funds on the Bank to the Future platform be available on the secondary market?
Yeah, so this is a really good question. And when we first entered into beta, it was kind of like the whim of the team and what we thought was right. So what we've been working on is really some principles around what is the minimum requirement to make it to our secondary market. And two of those are really easy to verify, and the third one is a little bit more tricky. But as a minimum requirement, what we're looking to do from here, when we come out of beta, is we want to go live with one market every week. So at the time of this live broadcast, we're just about to go live with the Bitso SBB, which is the largest crypto exchange in Mexico. And they just had a recent pricing event, and a series of high-profile venture capitalists came in at this price. And so we're releasing that with the price floor of where the venture capitalists, the full-time professional investors that do this by career, where the price that they entered in at. So that would be the price floor. And we're looking to enter another market each week. And how are we actually going to determine that? Well, we've initially set 3 criteria, and we really appreciate any of your feedback around what you think additional criteria might be based upon your investors' feedback. But the first is that they've actually launched a product. So we, in our primary market, might launch a company, might invest in a company that has an idea or is in the middle of developing a product. We want the product to actually be live. We don't want to have a secondary market for products that aren't live yet, because we think that that level is for the primary market and not quite for the secondary market, where people may not, because the reason that we do this is in the primary market, we're working with the company, and the company in securing their funding will be willing to disclose more information, and there'll be certain requirements around disclosures. In the secondary market, we're not necessarily working with the company. You know, the seller is not the company. The seller is somebody that bought the shares. In which case, we don't necessarily have any rights to any information, and therefore it's a bit trickier for an investor to be able to try and get the information that they need. And so one of the really important things that we do is we disclose, you will not have information rights, and that makes it higher risk, because you can't force the company to give you information. And so one of the criteria based upon that is that they have a product already on the market. It's a well understood product. People know what that company does. They're not, it does. That's the first criteria. The second criteria is not that they've just built a product, but they've sold a product. They have customers. They've proven that they can build a product that people actually want to buy or use. So, when you're looking at all the companies on the secondary market, you clearly know what their product is, and also they've got a bunch of customers that have used their product. That's the second criteria. The third criteria is a bit more subjective and has a bit more legal nuance. But we have an investment committee at Bank to the Future that all, that all decision making is spread across different parts of the ecosystem within Bank to the Future. And one of them is that none of the organization at Bank to the Future does not have information that makes us feel that the company is on a path towards failure already. That doesn't mean that they're not going to fail, because this is still high risk, high return investing. But we haven't been given any information through any information rights that we may have or may not have. It depends on we disclose whether we have them or not on the secondary market. We haven't been given any information that makes us feel that this company is on a path to failure. We don't really we're not in the game of saying whether this is a good investment or bad investment, but we just want to make sure that we haven't got some information that's been brought to our attention that this is just, the original investors dumping their stock or their SPV onto another investor that doesn't have quite as much information, and this investor knows that they're on a path to failure. If we can prevent that wherever we can, it's not a perfect system. Then if we have such information, then they wouldn't qualify for our secondary market. Or if they're on our secondary market, it's worth noting that we have the right to suspend that market if such information comes our way. The whole essence of this market is not for insiders to have more information than other investors, and therefore they get to sell their shares to. That's what we're trying to prevent. That's a very tricky thing to achieve, but that's the essence of why we introduced this rule. That doesn't mean that we can offer some kind of guarantee that they're not on a path to failure. It's just that we haven't been disclosed some kind of information that makes us think. So we have several companies on our primary market that have disclosed to us that there's board disputes, and therefore they're thinking of closing the company. If that type of information was made available to us, we wouldn't put it on our secondary market. That type of thing. Or we have certain information that the company has disclosed to us that that this is really not going the way they wanted it to go, and they're very close to running out of money, and they're not thinking of doing a further funding round because they think it's a failed project or something. If we had information like that, then we wouldn't allow it to go on our secondary market.
Yeah, and I think a point to raise is we have a wireframe, if you want, of policies of how this secondary market is to be regulated. But as we proceed, though, that policy may evolve, and details around what is the criteria, what isn't the criteria, what we do under certain circumstances, all of that detail may start to come out, and the policies may change somewhat or evolve to adapt to what we are learning from the use of the market. And in effect, we want to ensure a fair playing field for all persons who are entering into the market, and that requires us, to somewhat regulate it. As we were saying, this is essentially about alignment of interests. We don't want a situation where investors who were participating in the primary market and newcomers into the market, and newcomers somehow are disadvantaged by their lack of information, that other people may benefit from that. So it's about a level playing field, and to ensure some fairness in the way that that's done. So details to follow, but those are the basic 3 principles that we're adhering to.